So we're joined today by Emma Barrow from the Financial Services Compensation Scheme, or the FSCS.
Yep.
Is that right?
Yeah, that is right.
Yeah, that's good. Good
The
stuff.
acronym doesn't always get in the right order, but that
No,
one's right.
I see people say all kinds of things,
Yeah.
honestly. You know, that cover, that's all they say in the end.
Yeah.
So I think that's a good place to start, really, because I think we all hear authorised and regulated by the Financial Conduct Authority. So they're protected by the Financial Services Compensation Scheme.
Yeah.
What do you do?
A lot of things, actually, and I think more than what most people do. Most people are typically aware of FSCS because the logo's on the bank statement or on the app that you use for your typical day-to-day banking. So your banks, your building societies, things like that. And that we call that deposit protection because the kind of regulated term is accepting deposits. So if a company accepts deposits, that does deposits.
If they take money in off people.
Yeah, absolutely that. So the money you keep in your banks, in your building societies, either as cash, like in a current account, or cash savings, covered by us. So that's the kind of thing that most people know. But beyond that, we actually cover a lot of other products as well. So insurance, a lot of people don't realise this, but if you're dealing with a UK regulated insurer and that insurer happens to go out of business, we will either replace the policy for you or refund the difference, the kind of premium that you had left. And we can cover any claims that might arise at that point as well. Other products, a big one, I think, possibly for your viewers and listeners, financial advice. So actually, if a regulated advisor goes out of business, can cover that too. Prepaid funeral plans, that's a new one that we started covering when they became regulated last year, July 2022. So funeral plans, debt management plans as well. Typically people who have debt management plans haven't got a lot of money, but if that money gets lost, that could be, quite devastating for those individuals. So we cover those too. And generally kind of investments, pensions, home finance advice, a lot of that is covered. But as you say, it's the regulated. As long as the firm's regulated, that's kind of what
is this all free, or do you charge for these financial? If you need like a financial advisor, is it free or?
So our cover and our protection is completely free. So you don't pay extra for that. You wouldn't pay kind of a premium on top of anything that you've taken out for that. And if you ever need to make a claim with us, some things like deposits, the money in your bank, you wouldn't ever have to make a claim. We deal with that automatically. But for anything that you would have to make a claim for, typically financial advice, things like that, there's no fee either. So the scheme is funded by the industry. So you don't pay anything. You can make a claim for free. Some people do choose to use like a claims management company or a solicitor, but you absolutely don't have to do that. You can do it all yourself and it doesn't cost a penny.
Funded by the industry?
Yeah, absolutely.
So how big are the reserves here?
Interesting question. And some people, the funding thing is kind of something that people don't always understand. And we get some people maybe thinking we're funded by the government or the taxpayer, ultimately you and I. But no, it is industry funded. So how that works is each year we look at what we expect to need to pay out. And that's across all those different products that I kind of mentioned. And we put together a forecast and we call it our levy forecast because that's the sort of technical name for it, is a levy. And then each year we bill firms across the industry for that levy. They pay us, we pay that out as compensation. So we don't actually hold a huge amount at any one time. It depends on what we actually expect to pay out. So we do a lot of forecasting work with the regulators, with the industry to look at what we might be needed to step in and do.
But how ready are you if it all goes tits up
and
there's like
really good question.
A civil war or we go to war with France or something? Yeah. I mean, we spoke to the Bank of England a few weeks ago and they've got 400,000 gold bars sitting underneath their offices, underneath their building.
They only actually own 2 of them. Everyone else has gold, but they got it.
Well,
so how liquid are you guys? How prepared are you?
It's a good question. So without kind of getting into the real technical detail, each class of industry, each class of firms as part of the industry have a limit that we can bill them every year, and that's set by the regulators, and that's so that we can make sure we're only ever billing what's affordable, and we don't obviously make businesses collapse through just asking them for that money. So for deposits, which is the banks and building societies, that limit is 1.5 billion in a year. So we can charge that whole industry sector in total 1.5 billion. In addition, we've got a credit facility that's about another 1.5 billion. So that takes you up to 3 billion, and that's available within a few days. So we you'll see that if you read our annual report. We pay to have access to that funding facility. Beyond that, we can borrow from the Treasury. So if you look back at what happened in 2008, 2009, when there were a lot of banking failures, in total we paid out about 20 billion in the course of about 2 years, and that was borrowed and then recouped. So what we can do is we can then levy in the following years 1.5 billion a year to get that back. Also, what you've got to remember is when a bank or building society fails, it doesn't mean that all the money's gone. It can just take a while for it to come out in the insolvency. So whenever anything fails, we can access that money to pay out quickly, because
like
that's the important thing.
Like a stopgap until they can...
And then we actually work to recover that money through the insolvency, so that eventually it all comes kind of home to roost eventually. So yeah, we can access funding pretty quickly, and we can borrow as well, which is important. Because I know people are concerned about that obviously we're not sat on trillions of pounds because that money isn't there, but we can access it really quickly.
I think people's fear is like a domino effect within the banking industry, and we saw how interconnected all these banks are, and if one goes, potentially that can be like a contagion. And it's like how quick or how big is your checkbook, essentially?
And I think we wouldn't ever know until we got to that point. But I say, if you look back at what happened in 2008, 2009, 20 billion was kind of brought and paid out pretty quickly. I think things have changed a lot. I know you might have spoken to the Bank of England and others, but things have changed a lot since then as well. Like the way banks are capitalised, the way that they have to keep money and how much they have to keep, and everything around that whole situation has changed a lot since then, I think, with the lessons that were learned. So although we see some deposit failures, I think in the last 10, 12, 15 years, all we've seen is tiny credit unions. And
so it's not very common Armageddon for a bank, really?
No, we've not seen a bank failure ourselves since that time, since 2008, 2009.
Yeah, because I think one thing that when I speak to people online is I try and reassure them this isn't the only thing protecting them. There's actually the cash rules are probably more protective.
And the Bank of England basically have two options when a bank looks like it's in trouble. One is insolvency, which is when we step in and pay depositors back. The other is resolution, and that's when they can bail in, do all these other things, and I'm not going to profess to be an expert in it, but they've got other options that they would take. And you hear people use the kind of language like too big to fail, and there are banks that are so large there is specific resolution strategies in place if the worst happened, and they wouldn't involve us. That would be a different strategy to either bail in, create a bridge bank. There's lots of different options, and they say, I'm not going to profess to be an expert on it, but the Bank of England have loads of information you can read about that.
If I gave you £2 million right now, would you feel comfortable just having it sat in a bank, Barclays Bank, or not in particular, but knowing what you know about the...
Personally, yes. Yeah. And I think this is the thing is, how you keep your money is a very personal decision, and risk appetite is a very personal thing. But personally myself, absolutely yes. If I was lucky enough to have £2 million, I would happily keep it in one institution. I mean, obviously it would depend on where I'm getting the best value for that and things like that. And the important thing to remember as well is FSCS does have a provision in our rules that allow for temporary high balances. So although our standard protection is £85,000 per person per bank, it tops up to £1 million for up to 6 months if you
sold a house.
Yeah, it'd have to be a primary home, so it doesn't cover people who have like investment properties being sold, but things like selling your house, maybe you've had a large inheritance or a redundancy payout or something like that.
They're covered.
Yeah, you've got 6 months to sort out that £1 million.
But only up to £1 million.
It's up to £1 million.
So if the bank went under, would you not be worried about your other mill?
I'm just not worried about that happening on that scale. I say I'm not lucky enough to have that £2 million sat around, but my personal view is I wouldn't be concerned. Right now, I don't hold more than the limit, but that's mainly because of how much I have in cash savings. It's not a huge amount, so I'm not in danger of kind of worrying about that.
Can we talk about the limit briefly? Because it's 85k, it's 250 in America.
Yeah, $250,000.
Yeah, like their insurance. Do you think why isn't it higher in the UK? Why should it rise with inflation?
It's an interesting question because it's been at this level for a little while now. I can't remember off the top of my head how many years, but a good few years. And whereas other limits for other things have risen, it started that way because it was linked to EU rules. So EU depositor guarantee rules were set at €100,000 and everyone fell in line. And obviously we were part of the EU at that point. So we've been 75 and 85,000 and it's stuck at 85. Now we've left the EU, there's absolutely opportunity to change that. I think. And I know we, as FSCS, we were talking last year about reviewing compensation limits for pensions in particular, because that's the same limit, 85,000. And we have seen people lose a lot more than that. So we were kind of campaigning on that. And the FCA have said that this year, and I think very recently they just published a new strategy update, they are going to review the limits this year and put out a consultation on that. Because you're quite right, it hasn't increased in a number of years now. And with inflation as it is, that is eroding. I think it's important to remember that that is £85,000 per bank. You do have joint account protection as well. So if you happen to have an account with a partner, a flatmate even, whoever that is, you get that per person. So there is an opportunity to kind of get a little bit more there.
Could you just clarify the rules around, there's a lot of misunderstanding around the bank shared licenses and stuff and how that works with people, and give us an example.
Yeah, so it is per person, per bank. And the way that bank is defined is by its banking license. Again, you can check on our website. We've got a little checker where you can put in the names of the different banks that you might hold money with and see whether there's any kind of overlap, and the PRA have a list that they update every month or so as well on their website. But yeah, it's per banking license. The most common example we see is HSBC and First Direct. So that's one where they share a banking license.
Bank of Scotland and Halifax as well.
Yeah, I think they're part of the same one as well. And then there's Virgin Money and Yorkshire Bank, I think, or Clydesdale and Yorkshire Bank, something like that. But again, you can check that really easily online and see where that kind of crossover applies. And it is just a technicality in the rules that it's because of the way that the banks are structured and the licensing is structured.
We'll link it in the newsletter so people can put it in.
Yeah, great.
But really, do they literally put in and it will say, oh, these are the shared licenses?
Yeah, so I said the PRA have just a list. This is literally just a downloadable PDF that they update every month. But on our website, there's it's called the Bank and Savings Protection Checker, and you just put in the name of the different places that you hold your money, how much you have in each, and you can add them all on, and it will show you like how much of that is covered and how much of that isn't.
Okay, let's just a hypothetical situation now. I know you said that banks don't tend to fail very often, but let's say I bank with Barclays and they fail. Yeah. What is the process there? What happens?
So the process is the same for us, whether it's a bank, a building society or a credit union. And banks, we haven't seen failures of banks since the 2008-2009 crisis. But we do see small credit unions pretty much every year. And the process is exactly the same. So we have, and I'm going to try not be too jargony here, but we have something called an SCV file, and it stands for Single Customer View. And every single bank, building society and credit union has to keep this file, and that is their list of customers and their basically aggregate balances, so how much money they are holding on behalf of those customers. And once an insolvency of a deposit taker is kind of confirmed and live, they have 24 hours to get us that file. Okay. And we test this throughout every year, so we are constantly asking deposit takers throughout the year, live solvent firms, to send us copies so that we know that the process is working and that they're holding the data correctly. Once we get that file and we can check and verify it, we are then able to start processing payments for people. Now, typically, it's going to sound really old-fashioned, typically today, that's checks. And the reason it's checks...
Slow them down.
Not really, because we can get those really quickly. The reason it's checks is security. So if you think about it, if you had your account with Barclays aren't going to know that you also have an account with NatWest that they can pay into.
Only you can cash a check in your name.
Exactly. So but what we do have is verified by the bank, your name and your address. Yeah. So it allows us, that's the quickest way for us to get that money out to you. So checks, we have a remit to pay within 7 days. Typically with these smaller credit union failures we've been having, it's actually quicker than that. We've got checks out within 48 hours to people. Because as soon as we've got that file, it's very easy to do that. So the mechanism's really, really simple. It is by check, but nowadays, most apps allow you to pay in checks and things like that, so it's quite easy.
Okay. And same example, that the bank fails or something fails. We understand that it's banking licenses. So if an individual has two 85k pots with an organisation, First Direct and was it Lloyds?
First Direct and HSBC are one of the common
examples. So I'd only actually have one set of cover of
Correct.
85k. What happens if my partner banks there and we have a joint account? So there's 3 accounts.
Yeah. So the coverage is per bank and it is per person. It's definitely not per account. So you kind of have to look at all the money you've got with that one particular institution. So if your example was Barclays, if you had personal account with Barclays, you might have a current account, you might have a savings account. People tend to have the two together. Like you say, you might also have a joint account with a partner. Across all those accounts, you personally are covered for £85,000.
Okay.
So
are they as well.
So
you could share, you might only have like 30, 40k in one or whatever. And you can split it across.
Yeah, and like I say, the file we would get would be an aggregate balance, so we know how much you've got in total across all the different accounts. So we wouldn't SCV file. We wouldn't send you a check for every single account. We will send you one check for your kind of aggregate balance. So
that SCV will say within our organisation, this bank, they hold 82k total across all different accounts.
Yeah, so we get all that data. It allows us to, it's the most sort of simple way of doing it, and being able to pay everybody kind of neatly and tidily. But you can check banking license coverage, but also that kind of joint account, sole account coverage on our website. We've got this checker. You can put in all your different accounts that you have, either sole or joint, and it'll sort of put a nice little flag up and show you how much of each one would be covered in the event that something did happen and it failed.
Okay, perfect. So T, have you been using Blinkist?
I have indeed.
Just for context, that's the service that summarises books down into 15-minute, what they call blinks. So you can basically listen to that instead of reading a whole book.
I'm be honest though, our producer Big Will gave me a discount code. I got a free trial.
So. I did not get a discount code. What's going on there?
Yeah, you got to be in it to win it. But I loved it. I genuinely loved it. It saved me a lot of time.
What's your favourite blink?
The 4-Hour Work Week by Tim Ferriss. Mainly because I love to work for 4 hours a week, so it kind of gave me a bit of inspiration. Got a goal to aim for.
Yeah, decent. No, I love his podcast as well. Yeah. I wanted to test out some books that I'd read in the past that I knew really well, so I listened to The Richest Man in Babylon, and I thought the summary was really good. That's a really basic personal finance book it's like the gateway for many people, and I think they summarise the key messages quite well because a lot of it's quite like up in the air fairy tale story really. To get the core messages, the Blink was perfect.
Yeah, Blinkist is awesome. If you're a busy guy like me, a new dad, head to blinkist.com/making money. After
after 7 days, you get 45% off, I think is the deal.
Cheers, mate. Appreciate you.
Spell Blinkist.
BLINKIST.
Impressive.com.
/making money.
That's us.
Yes. Also, the link's in the description. So if you don't want to listen to us, you can just check it out.
Okay. Now back to the show.
Let's go.
And then just to finish off, your thoughts at a high level, how safe is our money?
I think personally, I feel very comfortable. I think we're in a strong economy. I mean, reports at the moment might suggest otherwise, but personally, I feel like we're in a strong economy. We've got so much change since the banking crisis of 2008, 2009, so much new regulation, so many new requirements for banks and building societies to hit in terms of like the capital they're holding and things like that. So personally, I feel really, really comfortable. I don't have my money under the mattress. It's all saved or invested with different regulated institutions, and I sleep quite comfortably at night with that. I guess none of us know what the future holds, but personally, I'm pretty comfortable that it's safe.
Okay, so I can get behind this thing of the banks, as in traditional high street banks, say like bank accounts are probably too big to fail. We've seen in America that quite a niche bank, Silicon Valley Bank, nearly went under and they bailed that out because of the damage. One area that I'm really interested in is brokers, as in trading and investment brokers. There's a lot of brokers at the minute that run at a loss as they try and drive down prices, but you still insure those essentially through you cover them. How do you feel about the fact that you have an insurance there that for lost businesses that are losing millions a year and that probably some of them won't survive?
So for us, the kind of stability of the industry and all of that completely sits outside of our remit, right? So that sits with the regulators, it sits with those kind of bodies and government and etc. How our protection works for things like brokers, so we had a couple of brokers, there's some examples you can read on our website, all of these, but there's one that went under in 2019.
Beaumont, was it?
Beaufort and
sorry.
SVS Securities. So both around that same time at 2019, 2020. And how our protection works in these cases can be very different. Because obviously if a broker fails, typically your assets and your money, although the broker is holding them for you, they are safe. They're not, if the broker goes under,
should be ring-fenced separately.
Absolutely, they should be kept separately. So in those cases, in SVS and Beaufort, how FSCS helped, because that limit still applies, 85,000 per person, is we paid the through the administrators, we paid the costs of transferring those assets to a new broker. So that's how our protection worked in those scenarios. And that's something that's quite typical for a broker failure. So instead of us kind of giving you cash back, we pay for the costs of transferring it, so you don't have to fork out, what it is, a couple of £1,000 a person, however much it might be, to move your assets to a new broker. And then obviously once you're with the new broker, you can then choose what you want to do with that. So that's typically how it's worked for us in like recent times. But it is very different to deposit taker failure in that it's not kind of just an automatic, here's your money back. A lot of work tends to have to go into
what kind
those
of
things.
time frames do you think to unravel a situation like that?
Really depends on the insolvency, because obviously once this company goes into insolvency, there's an insolvency practitioner, administrator involved. It really does depend on the situation. And FSCS, although we pay, we're not managing the administration, so a lot of that is outside of our control. We work really closely with them, but you can think of it in the case of SVS, it was around 12 months or something like that. It's definitely longer than the 7 days you're going to get on a deposit, but they're much more complicated, and the kind of rules are very, very different around how it works for things like
But it feels like it's more likely that people might need that support in that sector than it is in, say, traditional banking, where you've got these behemoth businesses that are almost protected by...
So each year it varies year on year, but in recent years, we've typically declared around 100 firms a year in default. So we've stepped in and helped customers of around 100 different companies every year.
And these are brokers more than...
No, so typically actually they're financial advisors. That's what I was kind of getting onto.
Okay.
Most of what we deal with is financial advice at the moment.
How does that go wrong?
So people give advice that isn't suitable for their client's circumstances, isn't suitable for their kind of declared risk appetite or things like that. And because most people who are seeking financial advice, they're looking to invest for the long term, right? They're not looking for a quick win. They're looking for maybe investing for their retirement or something like that. So how the typical chain of events is, you go seek some advice, you use a regulated advisor, you do the right thing. They potentially give you advice that isn't right for you. And obviously they have hundreds of happy clients who everything works really well for. You might only realise that advice wasn't great 5-6 years down the line, right? You come to retire or you come to assess how your money's doing. You then think, oh, something's gone wrong here, I need to complain, and the advisor isn't there anymore. They might have gone into liquidation. Obviously in this country, there's a lot of small firms. They're not all big firms. They can be one-man bands or, a handful of people. So they might have gone into insolvency. They might have just folded up shop and retired themselves or whatever. If they're gone, you haven't got anywhere else to go. You can't take them to court. They don't exist. You can't go to the ombudsman because they don't exist anymore, and you have to come to us. And that's when we will investigate the firm, make sure it is definitely insolvent, make sure your claim is valid, and then we're able to pay out on those claims. So those are what we see absolutely the most of at the moment is, I've had advice on a pension or an investment and it's just not worked out for me and it wasn't right. I think it's important to mention that we absolutely can't cover poor performance. I mean, that's what investing is, right? Again, it's back to your own personal risk appetite, and some investments do well, some don't. If you've invested in something and it's not turned out, that's kind of is what it is. But if you've taken regulated advice and that advice is proven to be not right for you, that's where we are able to step in.
Which areas would you say cause you guys the most headache or the most work? Would it be financial advisors or is it banks or...
It's financial advice and it's pensions in particular. They're the most complex claims that we see. So typically where someone has transferred maybe from a defined benefit pension, so an old workplace pension that's got guaranteed benefits, and they've decided to cash that in and move to a personal pension or a SIP or something like that. Those are the most complex cases we see, and we see quite a lot of those. Or again,
from bad advice, someone like explains to them, you've got a pot here that will give you an income for life,
100%,
and they've moved it over to a SIP and they've gone, oh my God, I've just burnt that benefit.
And people not really understanding the kind of impact of that. So not only the fact that it might not perform as well, but like you say, losing those guaranteed benefits, having to worry about your investment strategy, having to worry about your drawdown strategy or whatever that is, which you would not have had to worry about in your old scheme. So there's a lot of those kind of claims we've seen over the past couple of years. Poor investments generally, so people investing in schemes that the advisors recommended to them, but it's completely unsuitable for them. So things like overseas property, stuff like that, that just then completely has collapsed and they've lost everything.
As financial advisors are like regulated, shouldn't this happen less frequently? Aren't they meant to give you like sound advice that fits your risk appetite, and they ask you questions on, so how does this happen? So, how is there like a misalignment?
We see all sorts of different things, right? So sometimes it's genuine mistakes. People are human. They're going to make mistakes. They've missed something. And the difficulty for us is because we're only dealing with companies that have gone, we can't ask that advisor. We can't sit there.
Do they have to be gone?
For us to step in, yes. So if your advisor's still trading, you have to go to the ombudsman. That's where you would go. So you would complain to the advisor themselves, and then you'd go to the financial ombudsman. We used to be, you might have ever seen us referred to things like the scheme of last resort or the lifeboat fund or all these kind of like metaphors. But we are really that last port of call where there's nowhere else for you to go to try and claim some money back for what's happened.
How do you see it with someone like Neil Woodford then? Neil Woodford was advertised as a star fund manager within the UK, and he set up his own fund range, and those funds were advertised as relatively safe for investments that were focused on blue chip companies with a view for long-term growth. But he actually took the money and then speculated on investments that weren't even listed, so they were illiquid. Investors then got shut inside of the fund and couldn't get their money back out. But they were told,
investors.
Investors.
This guy.
Okay.
Well,
we were
personally involved.
I mean, I started with this 10 years because as a naive investor at the time, I came onto Hargreaves Lansdown and they were like, "This is the guy. Buy this. Look how shiny he is. Everybody buy this." And they continued to pump his funds even when they were collapsing. But then investors were told, "Well, that's just the way it goes." To me, that seems like misadvice. And why would people never, given their money back in that sense?
Yeah. So FSCS's role with this kind of stuff only kicks in if anybody in this whole chain goes out of business. So either becomes insolvent or through whatever other means is out of the market. Typically for us, so I'll use it as an example. If someone had invested in a fund off their own back, so they haven't taken that regulated advice that is mainly what we see claims for, obviously that shuts off that angle for us. So there's no advisor there for you to be able to claim against. There could be other regulated companies in that chain, a fund manager, for example, or someone like that who has breached whatever regulatory rule or guideline. For us, it does get really complicated, but for any claim that we see, we're looking at a couple of things. We're looking at you as the individual who's making that claim and whether you're eligible for compensation. And there's a load of rules sitting with the FCA about how we can pay compensation. Typically, we're looking at things like, are you an experienced investor? Would you work in finance yourself? Are you a regulated individual? Things like that. We're also looking at the firm and its actions and how it behaved and whether it did anything wrong. And ultimately, the test we're applying on a case-by-case basis is what we would call a civil liability test. So we're looking at if you took that particular firm to court, had it been in business, do we think the court would have ruled in your favour and said, yep, you were wronged by that business? The Woodford example is a good one because it's a live example. It's still very much in the news. I know the FCA have talked about there's a linked company that managed the fund that are being investigated by the FCA. And if any of the funds any of the sort of firms in the chain ever go out of business, then we would absolutely look at that to see if there's anything we can cover in that chain.
Do you separate advice from marketing? When you're talking about qualified financial advice, would you not say that false advertising would be?
It's interesting because we've got really strict rules on like what circumstances we can pay in, and a regulated activity has to have taken place. So that is something like advising on investments, arranging investments, accepting deposits, which you talked about earlier, so taking money in like a bank does. So there are certain things that are not covered under that regulated activities order. It all kind of boils back to the Financial Services and Markets Act of 2000, which is where we were kind of born from. So there are certain things that we can and certain things that we can't cover. And it's really hard to give a kind of yes or no answer until something actually happens because everything has to be investigated on its own kind of merits at that point.
One area that's clearly a lot of people are losing a lot of money through all different means is cryptocurrency. Yeah. And that doesn't fall under your space.
No, it doesn't.
Could you ever see a world where that was caught under that umbrella? Because if you treat it from a perspective of where the people need the help, that is it.
Yeah. So cryptocurrency as an asset, absolutely not covered because it's not regulated in the UK. If you were advised, again, by a regulated advisor to invest in crypto, that is absolutely something that we could consider because we're not looking at the crypto, we're looking at the advice that you were given. That's the activity that we're concerned in. So in some respects, I think a lot of it boils down to making sure people are getting the right advice. And if they are able to use a regulated advisor to make big decisions, you're not going to do that if you put in a few £1,000s into something, because it's just not going to be financially viable. What we cover and what is regulated is constantly under review, I think. And I know there's a lot of different bits of legislation going through Parliament and things at the moment. There's a new Financial Services and Markets Act. I can't remember the name of it, but a new equivalent of that's currently working its way through Parliament that might change things in the future. Last year, funeral plans came under regulation and became protected. So things are getting added all of the time. And I think there's always that gap, though, isn't there, between what consumers are doing and what's available, and how fast policy responds to that.
And also, people are just speculating in that space, and you don't protect against losses from speculation.
No, we absolutely don't.
But there is a lot of scams in that space as well, and there's a lot of
scams are really frustrating for me personally, because we can only cover you if you dealt with a regulated entity. If you're scammed and the person that you've dealt with is completely unregulated, there's literally nothing we can do, and that for me personally is really tough.
It's horrible
because we see so much of it.
Yeah, because I worked in the credit card industry, and obviously there was protections there. You could be pretty confident that if your credit card money was taken off it, you would have that money back pretty quickly. That was part of the perks. But at the same time, there's an argument of it kind of means that people become a bit sloppy because they know that they can just call up the card company and it can be reversed the transaction. So I don't know if you're bailing people out everywhere they get scammed, it would be. Does that promote more scammers into that place because they know that they can?
I don't know. I mean, some of the things that we see are basically people impersonating regulated firms impersonating. The FCA have got a page on their website that's constant warnings about impersonation and copycat.
Do people steal your logo and stick it on their website?
Yeah, 100%. That's so easy. That's so easy, isn't it? Right?
Yeah, well, I get that through my YouTube channel. People just take my profile picture and message. I'm clone my Instagram, message people and say, I'm Damien, invest in this cryptocurrency, and people fall for it all the time.
I got my Instagram hacked by that.
I've got about 8 people pretending to be
my friends vote for me for this influencer award. I'm like, sure, I click the link and then it's like, you're locked out of Instagram.
Yeah.
And I call my friend, they're like, that's not me. That's like a duplicate profile. So
it's so easy to do in today's day and age. And it's really, I say for me personally, it's really frustrating to see. Because, I mean, there are some scams that you look at them and you're like, oh God, that was so obvious. Why did you fall for that? But now they're getting so sophisticated. I was reading something a couple of weeks ago about how, do you remember, even just a couple of years ago, spotting a scam was all about, poor spelling, whatever. ChatGPT is changing how scammers are behaving overnight, because they're able to pump out really realistic sounding promotions.
Now
they're able to just turn something out that's much more convincing than
French,
it was. Yeah,
write me a fine. You are, yeah.
It's scary, really, how easy it is for people, and I think. I mean, I always say to my parents and, friends and family, doing your research is so important. And I know the FCA have talked about bringing things in kind of cooling off periods and things like that. And I personally think those are a great idea, because that's something a scammer wouldn't do, right? They're not going to have a cooling off period in an investment or anything like that, because they just want your money and they're gone. And I think that's kind of as you say, with things like crypto, people are being speculative. There is a bit of a maybe fear of missing out and wanting to kind of get involved in something that looks pretty lucrative. Yeah, and you can make snap decisions that are possibly not the right thing to do. And that's where scammers are rife, right? Because you make that one snap decision. And
if someone does get scammed, can you help them if they're with a bank? So, sometimes they call up old people and they say, we need your card number because an Amazon purchase has been, and then they go and give all their details. If they then get scammed, I guess the bank will cover that?
Yeah, so because we can only step in if the bank's gone.
Okay,
they would go to the bank, and if they response from the bank they weren't happy with, they can take that to the ombudsman.
Yeah.
But if the bad advice came from an advisor who was qualified, you can step in. But if it was a scammer pretending to be that person, you can't.
We can't, and that's the difficulty, because there's no regulated entity there for us to sort of pin that claim against.
And it's only going to get worse, as you say, with technology.
I mean, I think it is. Yeah, personally, I think
security can also get better with technology. Like for this transaction, do a face scan or like, you know.
But I think it's really hard for people trying to get into investing. You know, like I was like this a couple of years ago. I never invested. Everything was in cash. And mainly because I was scared because of what I'd seen working in finance. And I was thinking, goodness, it's so hard to get in. And if you can't afford financial advice, which is expensive, it's not really viable if you've got a small amount of money to invest. How do you get into investing for that first time? And I know, again, the FCA are consulting on a new kind of part of the advice regime that is going to allow simple advice to get into a stocks and shares ISA for the first time. And I'm not involved in all the detail of that, but on the surface, that feels like a good idea to me, because I do think people need help to get in and make that jump from cash to investing.
I've heard about this podcast called the Making Money podcast. I think that's a good way to get started in investing.
But it is hard. I'm guessing you get a lot of people who...
Yeah, well, I mean, I did an Investing for Beginners video that's got like 500,000 views, and people just say, like, why is this not taught at schools? Why is there not this open conversation? Why do I have to seek this information out? Or why do I have to pay hundreds, if not thousands of pounds just to be told, if you take a little bit of money and put it in this ISA, like that will change your life if you do that consistently over a long period of time. But yeah, the broker point. So I asked my audience for questions for you, and there was financial advisors asking me questions for clarification, which I thought was interesting, because I think there's just some kind of myths and misconceptions about what you do.
Yeah.
They were talking about, if you have money on a broker, like a trade in 212, a free trade, whoever, but I then buy Vanguard funds, where's my cover? Am I covered through Vanguard because they hold the money, or am I covered through my broker? So
depends on the type of company and whether they're regulated or not and what they're regulated for. And it depends on what happens, I guess. So if you were in a platform, like a couple of examples that you gave, and the platform itself collapsed, and like you said, but the fund you've got is with someone else, then the fund is still going to be there, assuming that they did what they said they'd done and they bought those funds on your behalf. So that would be like the example I gave earlier, where potentially what we could do in that situation is help you move to a new platform and work with the administrators to facilitate that. If the fund itself collapses underneath and the provider's still there, then it would depend again on the circumstances, whether that fund was, whether it was just poor performing and that's life investing, or whether there was mismanagement there and whether there's a regulated company there to turn to. So it depends entirely on what actually happens. And this is why it is quite difficult to say, yes, that's protected and no, that isn't, for anything other than deposits, really, because it will so depend on who was involved, what happened, and all of that has to come out in any investigation. But in theory, it could apply to either. So it could apply to either the platform or the fund underneath it, or indeed both. So we've seen you can have 2 or 3 different regulated parties involved in one chain. So I dealt with a case recently of a lady who came to us who was misadvised on a pension. She actually ended up over the space of a few years at making 4 different claims against 4 different entities. She had incredibly bad luck, but in part of her journey, there was 4 different companies that had gone bust, that had all done something not quite right. So incredibly bad luck, but you just because there's one event, if there's 2 firms involved and they both happen to be out of business, that you can end up having claims against both.
I know it's a feature of the fact that you only insure advisors, but it's also scary to sit here and listen to you say, well, you should get an advisor, but the advisor's aware of all the
they can charge you money and then give you bad advice.
You've got to put this into perspective, right? So we might be declaring, say, up to 100 firms a year in default. That's across a market of thousands and thousands and thousands and thousands of advisors. And a lot of times, those firms that fail might only have a handful of claims. So you've got to put it in perspective. It's not... all of these advisors are human beings. Mistakes will be made throughout people's careers.
Especially over a whole country.
100%, yeah. But that's why we're here, right? And we're there to be able to, even if it is just one person that has had poor advice and that firm's gone out of business, if we can prove that that's happened, then we can help that one person. And for me, that's really important.
What would you say is like a common misconception or like the biggest myth you hear about FSCS? Like, will people come to you and say, can you help me with this? And you're like, no, we can't, we don't do that.
I think the biggest misconception is usually about things like when we can step in. So all the different conditions that kind of have to be met. So the firm has to have gone out of business. There has to be no other kind of recourse for you to be able to follow up. And the fact that if it's still trading, you've got to go to the ombudsman. I think the other misconception is that people can't kind of make a claim themselves, and we talked about this before, but it's free, and that's something we get asked a lot is, do I need a solicitor? Do I need to use a claims management company or whoever? You can choose to do that if you want to, and they'll handle the paperwork for you, but you can completely do it yourself. I think for me, the biggest thing that, and I see it a lot online and when I'm talking to people is, and it's as frustrating for me as it is for other people, not being able to give you a categorical answer and say, yes, that's protected, and no, that isn't. And that's just a function of the rules and say all these eligibility criteria and things that have to be considered if a firm does actually go out of business, and all that in kind of individual investigation that has to go on. We call it like the invisible effort. It's the stuff that we're doing behind the scenes to check that those claims are eligible and check that everything's kind of okay to be able to pay compensation. So people get really frustrated and sometimes I get a bit scared, I guess, that we can't just be like, yes, that's 100% covered, and no, that isn't.
It's a symptom of the times. Everyone wants like instant gratification. They're like, let me type in my details and you just give me an answer now. But
yeah, and you get it. And we can give those categorical answers for deposits, for the money in the bank. We can give that categorical answer for insurance.
They're weird about brokers. They don't like me sitting there going, this broker is covered. Because they're like, well, yeah, it might not be, all the investments might not be, and they could be somewhere else.
There are so many individual circumstances that apply to every different transaction, every different individual that's making those investments, that it is really hard to give that categorical answer.
So, let's say you're a retail investor and you're putting your money into a broker and you're trying to better your life, but you also want to be conscious of just setting it up in a way that gives you the most protection. Is there any best practices that someone could go through, like places they can check the brokers, types of investments that they should stick to? Or
so the only thing I can give you here is my personal view, right? Yes, so please. I can't give you advice. I'm not an advisor myself.
No.
Otherwise we'll be seeing you in a couple of years. She gave us this advice. You authorised that. She owes me 50 grand.
I have considered doing the exams, just to sort of live it from that side of it. And one day I might do that. But personally myself, I always check the company's authorised. So that's the first thing I will do. I go on the FCA register. I check that company's authorised. I check that there's no clone warnings or any of this stuff. That's
people impersonating them.
Absolutely.
Fake websites and stuff.
So I go on, I check that, I check the details, because the FCA register has the registered number and the registered email address and the registered web address, so you can check that
you're using the right channels.
So that's always my first port of call, personally, no matter what I'm doing. And then I know this is kind of cliche, but I think about what my objective is here and how much my risk appetite actually is for this particular thing I'm doing. So is this a big part of my retirement fund? Is it a small part? Is it something that, like we said before, it's something new that I think, you know what, I'm going to speculate and put a little bit of money here. So I do have that proper conversation with myself about how much I'm willing to lose out of this money. And that ultimately is very personal, and that's very much, each individual will have a very different appetite. I might be putting £1,000 into something and that's out of a £50,000 retirement pot. I might be putting 50,000 in, but my retirement pot is 20 million. These are going to be very, very different decisions. So I always check the register. I always check that they're regulated. I will look at other people's reviews of them. I mean, I am guilty of that. I know that it's not good to take advice off random people on social media, but you can see.
Yep. It does paint a picture sometimes.
Of course it does, especially if you check multiple sources, which I do. I will look at.
And if there's 5,000 5-star reviews, you kind of.
You've got. So I do my, and I can never say this, due diligence. I do that, and I do check and look at what protection might be there. Personally, myself, I'm not that worried about firms going out of business. I'm not that worried.
I think that's reassuring for people to hear.
The biggest ones we see are insurers, but actually because they're the way that works, it's so easily resolved. Their individual detriment is not an issue with
How does an insurer go bust? Is that they don't have enough money to cover the claims? Because
basically, yeah. So
natural disaster or something like this pushes them over.
Could be anything. So we had one not too long ago, maybe about 18 months ago, called MCE Insurance, which was a motor insurer. They primarily did motorbike policies and scooter policies and things like that. They had around 120,000 policyholders when they went bust. And exactly that, they ran out of money, right? So they'd sold policies and were getting too many claims and the premiums weren't covering the claims. So very easy kind of column A didn't add up with column B
situation. If your insurer goes bust, should you be pretty confident that that's going to be okay? That'll be quick resolution?
It's pretty quick. So typically what happens is the again, without getting too complicated, the insolvency practitioners who are brought in to deal with the insolvency, they appoint what they call a run-off agent. So it's someone to step in and manage the insurer while they sort it out. So what we do in that situation is we're either going to find you a new insurer and pay to move you over, so your cover just carries on with a new insurer. Or if you were, let's say, 6 months into a 12-month policy and we can't find a new insurer, they're not willing to take on those policies, we give you that refund for that money that is left. So if you paid £1,000 for a 12-month policy, you're 6 months in, you're getting £500 back from us, and then you're able to go and replace that policy. Get another insurance. And we also cover the cost of any claims. So if you, in the case of MCE, there were people with active claims, their bike had been damaged or stolen or whatever, and they'd made a claim, we then step in to fund those payments as well. So it's pretty seamless when it comes to insurance, and they are the biggest ones we deal with, the largest number. The
largest ones, but mainstream banks and big brokers are not that typical.
No, not at all.
You said the phrase "too big to fail." Do you genuinely believe that still exists? Or
personally, I do. I say very personally, I do.
Lehman Brothers, and then more in crypto, that's not regulated. But FTX, recently they collapsed, and Lehman Brothers. So do you not think that wars or different circumstances or quantitative easing, all this printing money can affect the economy so badly that a bank can go?
I think banks can fail. I mean, the regime is designed so that you'll see things from the Bank of the Treasury. They say it's not a zero failure regime. It's not, nothing can fail. Like we said before, personally, I wouldn't feel uncomfortable holding large amounts of money with large banks, but it is very personal. It's up to every individual to decide on what their risk appetite is. And you say with your money in your bank, if you do believe that there are no firms that are too big to fail, if you believe that every bank's at risk.
I'm a little bit sceptical now after the last decade.
Well, if you are, then you can make that decision to split your money around, right? Yeah. And you can make that decision to manage different accounts with different money in it, right? Yeah. You can make that decision for yourself personally. I think that's the key thing, is that there is a solution to that. If you are worried about a large bank and you're holding more than 85,000, then split it. That is nowadays pretty easy to do. Pretty easy to open an account with another provider if that's what you want to do.
What about investment products like pensions, which will obviously have significantly over 85k in value typically?
Yeah, there's no real easy answer to that. Is there? Again, it's about your personal risk appetite. If you really want to take it all and put it under the mattress, then you can do that if that's what you personally believe. There's no real answer to your own risk appetite and what you're willing to do. Personally, I educate myself, I read a lot, I listen a lot, and I try and make decisions that I'm personally comfortable with and allow me to sleep at night. And for me, that is a fairly standard workplace pension, a couple of personal pensions that I've opened over time, some money in different banks, and a few basic investments. I'm sure a lot of your listeners and viewers will talk about this, but it's all about personal risk appetite, diversification, spreading your money about, do things that you can sleep at night doing. That's all I can really say, I guess.
But the people who are the last port of call, like the people with the safety net, are saying they're not too worried. Well, you're saying you're not too worried.
Personally, yeah.
Not all of the people.
Do you know with some people that are like, oh my God, we're doomed? It's like the whole...
Personally, I don't, but it's funny because I get a lot of friends and family who will come to me and say... It's interesting how different people can influence each other, right? So I had a friend recently message me. She's not a particularly close friend, but a decent friend. And she was like, you know what? I've always taken investment advice from a guy at work. She was like, I know. Maybe that wasn't the right thing to do, but I always have. I've trusted this guy. I've worked with him for a long amount of time. And he's turned around to me this week and told me to sell all my stocks and shares ISAs and buy gold. What should I do? Yeah, and that was my first reaction was, oh God.
Is he regulated?
Well, clearly not. It is just a friend at work. Yeah. But how normal is that realistically? It is very normal that people trust someone that they've worked with or a friend or family member that they trust in other aspects of their life. So she's always followed this guy's advice, and he's not regulated. He's just a guy she works with. And to be fair, the advice he'd given her in the past was decent. She'd opened a stocks and shares ISA. She'd been putting money into that. It was very mainstream. Very retail investor, all fine. And suddenly he's panicked. And it was so interesting how quickly that had spread to other people.
Yeah.
And I said all the same things I've said to you. I was like, I can't give you any advice. That isn't my job. I'm not a regulated advisor. But here's some things you need to think about. You need to think about if you're putting all your money in one asset, what that means. And I kind of educated her on things like, if you buy gold, you have to store it. It's not, if you're physically buying gold, either someone has to store it for you, and you have to then trust that person. So if you're doing this because you don't trust, well, are you going to keep it in your literal house? Like, what is this? And it was kind of like opening those questions up, and those kind of discussions was quite interesting. But I found it really interesting how quickly that worry can spread amongst people.
Yeah, it's interesting that the paranoia and fear around banking collapses, which the media pushes a lot. You know, they're like, oh, the next 08.
The journalists have a lot to answer for, definitely, right? But that's their job, isn't it? Their job is
it sells a headline.
Stories. Mm-hmm.
But then actually what the biggest threat to people is making bad investment decisions by listening to people who don't know what they're on about. Yeah. And, you know, as a social media person, I am part of that, right? Like, if you look at the YouTube space, people click on negative things. That's just, and if you're...
It's human nature, isn't it?
Yeah, you're drawn to them. And what people don't understand about YouTubers maybe is that is their main source of income, and that's how they pay their bills.
Yeah.
So they have an incentive to be negative, and that can then feed into people, like you say. And that guy might have watched a video that morning where
he genuinely believed it. He genuinely
someone's
believed
got to flip everything into gold. But that guy won't be doing that. He's just doing that to get his cash in from his views. And then that feeds out.
There's a lot of responsibility, isn't there, on, like, say, media
threat
shoulders.
To your finances than your services ever needing to come into play, essentially.
Personally, I 100% believe that, yeah. I thought when I started working at FSCS that, like, exactly as you say, I might think, oh no, I've seen the inside now, I'm really scared. It's
the opposite.
Absolutely the opposite, yeah. I've invested more since I've worked here than I ever have before.
I was expecting you to sit down and be like the Men in Black, like, we've saved the world 10 times today. Do you know what I mean?
You don't even know before you had your breakfast.
Do the little flashing thing. Just like a wheel come out and it's like, what day is it?
Don't get me wrong, like, the work that we do is absolutely important. And I see cases day in, day out of people that have been misadvised and have lost pensions, and we are able to step in, and it's great. And we do help a lot of people. We help thousands of people a year. But I think we said before, we're a small organisation, we're 250 people. The scale of this is not massive.
Shows that there's not that much inbound traffic versus, say, when we used to deal with Citizens Advice, and they would just be getting thousands of calls a day. So the fact that you've got 250 staff shows you're not getting billions of calls.
No,
you know?
We are the safety net, right? And we operate like that, but we're not, as you say, we're not having to save the world every single day. It's not that kind of situation at all, no.
If there's someone at home now listening who thinks, I got advice 5-10 years ago that I don't think was right, like, what do they do to get in touch with you?
Really great question. So how our service works is... we can't investigate every single firm that goes out of business, right? Yeah. Because first of all, we don't know if they ever gave any bad advice or did any bad work. They might have had a complete clean bill of health, but also the amount of companies that are folding, and say for either because they're insolvent or just because the person's given up that business or whatever, is huge. So we rely on former customers coming to us and saying, I actually think I had a bad experience here. So on our website, there's almost on every page, there's a button that says check if you can claim. And what you need to do there is you go into that. It asks you a few very, very basic questions. Who the firm was. So it's really useful to know the firm reference number. So their FCA firm reference number. You say what kind of product it was, pension, investment, funeral plan, whatever. And the dates that you dealt with them. So roughly, if some people won't remember, but you can put in a rough date. And all that's doing is checking that at the time you dealt with that firm, they were regulated. So it's just doing a really basic check on, has that firm gone out of business? Did you deal with them at a time when they were regulated? If it gives you a nice green tick and says, yeah, that firm was regulated at that time and you're able to make a claim, you then register an account on the website and you can go ahead and make a claim with us. The process can be fairly lengthy because we need to see some evidence, we need to see some sort of paperwork that you dealt with that person, obviously. But once you've made an account, you can start your claim and go in and out as many times as you like. You can kind of log out, leave it, come back, do whatever you need to do. And what we look for to start a claim is just some really basic evidence that you dealt with the company. Maybe you've got emails or paperwork, and people can just take photos and attach them. They don't have to be like original copies at this point or anything like that. But every product has a slightly different application form online. We do have paper application forms, but I think it's like 99% of people do it online nowadays. It's much easier to do, but we do have that option if anyone ever needed that. And people go in, fill in all the things that we ask for, submit it, and off it goes. And then if that firm has already been declared in default, so maybe another customer has already complained about that firm, it'll be a bit quicker because all the kind of investigation of that company's done. If someone claims against a company that has never been investigated by us, we do have to start that process from scratch, and it can take quite a long time.
Will you investigate any claim?
We'll investigate any claim that comes in.
So it's not like we need 10 before we take it seriously?
We only need one valid claim to declare a firm in default and be able to pay out. So it can be that, and often it can be that one person that tips it over. That's all it takes. And sometimes we only ever pay one claim. That might be the only one we ever pay.
Well, I've always said on my channel, like, this exists, it's great, and a lot of countries don't have this.
Yeah, a lot of countries don't. A lot of countries only do deposits. So there are not many that do kind of all the different products.
The funeral one's really nice, because you think about how heartbreaking that must be for a family especially if their nan has paid into a funeral product to cover their funeral, they die, and then it's like, oh no, we're gone bust, the money's gone.
Yeah.
How quick are you on that?
So funeral plans only came into regulation last July, so July 2022, so we've not had a failure yet.
Really? No failures?
We've not had a failure. Now, bear in mind that to get authorised, there was a lot of providers dropped out at that point, so I think about 26 made it through and became FCA authorised.
So you cleaned up the market by...
Well, the FCA did. That definitely wasn't... I'm going to take credit for that.
No, but it essentially will have cleaned the market, because all the people that were like, oh, we're not going to try and get regulated, are the ones that probably are a bit dodgy.
So the process did filter out a lot, and I think there was a couple of big ones. One was called Safe Hands that we were in the press around that time because they didn't meet the criteria for authorisation. They weren't good enough, basically.
Can they still sell the product, but they can't get a stamp of saying this is covered?
I think that's it now. I think they can't sell the product. And then old plans were kind of moved over to different providers and things like that.
I worked in the debt management industry when that went from unregulated to regulated, and it was like cowboy industry prior to, before I got there, but 5 years before, it was wild what was going on in that.
Before I got there.
I cleaned that whole thing up. I was like the new sheriff riding in, this is all going to change. Yeah.
Do you think since you started working at the FSCS, you started...
I know.
FSCS. Do you think you got better with money, better with investing, or do you think you were always good with money?
You said you feel more confident.
Because you said it made you more confident since you've been working.
I think I've got better at it. I think I've thought about it more because I'm surrounded by it every single day, right? So I had worked in financial services before, but I'd worked in retail, building society type environment. So at that point, I'd gotten really good at savings mortgages because that's what the building society did. But I'd never really thought about investing, advice, because as I say, it isn't taught at schools. It isn't something that necessarily people are exposed to day to day, but because I'm around it now every single day, and I work in communications, so my job a lot of the time is trying to simplify things and explain things. It's naturally I've had to get really involved in the detail, and that has, like I say, it's reassured me. It's made me feel much more confident than I was, and also that kind of education I've given myself over the kind of 3 years I've now worked at FSCS has really helped me personally, and it has made me think about things like, why isn't this more available to people? What is it that we're missing? What is that trick that we're missing in this country that people aren't confident enough to invest safely and sensibly, and having to, people like yourselves having to fill this gap really.
I shouldn't have to exist.
Realistically, no.
It should be provided by the government in terms of financial education, but it's not, and it allows this market to operate that actually is not regulated, which is kind of dangerous in a way, isn't it? Mm-hmm. I would like to think that I have good morals and that I'll sit there and say what I do and won't push people into bad things, but I know that people do because they get offered money to do that, and that exists online. And if you regulated it and gave quality advice from the government, none of that would need to exist.
It wouldn't, but you kind of I do have these kind of moments where I sit there and think, but the way humans are, I think there's always going to be something that's I think
there's an inherent lack of trust.
Yeah.
And even in you're there to be this insurance, and the questions are people like, but who's paying for it? What are they in their pocket?
And that's really hard to get around, isn't it?
There's a lack of trust. Yeah. And that's kind of why we wanted to bring you on, to sit here as a human, and say I work there and I trust the system, and I'm happy to put my 2 million quid in the future.
I wish you stopped talking about my fictitious 2 million.
It's coming.
And I am. And I say, if anything, it's done nothing but increase my kind of trust in how things work. But it's such a personal thing, and like you say, all people can do is try and expose themselves to as much information as they can absorb in, and listen to different views, and ultimately make that decision up for themselves on what they're comfortable with.
Well, I hope that's reassuring for people listening.
Yeah, I hope so too.
And thank you for your time.
Yeah, no problems at all.
Next episode, we're speaking to Kerry Katona. What a chat that was. When it's out, you'll find the video here. To get a bullet point summary of this episode, which I definitely want, there was a lot of information in there. Sign up to our newsletter using the link in the description below.